And we're live. Hey there, everybody. It's Mitch Goldberg, your host. You're watching Be the Boss of Your Money. This is my live stream. I do this every Monday through Thursday at 4:30 p.m. If we haven't met yet, I'm a financial advisor with 31 years and counting of experience. We're getting started today just a tad late. It's one of those days. Listen, we all have one of those days once in a while. That's the beauty of going live. Just it's kind of homemade, right? And I don't know. I think that homemade feeling with content definitely resonates, certainly does with me. So thank you for joining. Your time is very valuable, and I appreciate you spending some of it with me. We're going to go through a quick rundown. As you know, I don't do these streams on Fridays, so I just want to give a quick catch up. Let's see where we are in the world. Let's see what's next, because right now it looks like all of a sudden the stock market seems to be somewhat directionless and a little stuck like a deer in the headlights. It's not really moving up big. It's not really moving down big. It's just kind of stuck. And don't get me wrong. I don't mind some slow days. In fact, I prefer it. I don't like these giant down days followed by the giant up days, because the giant up days are often repealed pretty quickly. So that's something that we're going to get into. So let's run a quick rundown, quick intro, and we're going to get into all the different screens and some important things I want to show you. Here we go. All right, we're back. Thank you so much. If you're just joining us right now, I'm Mitch Goldberg. We're just getting started. This is my live stream. It's called Be the Boss of Your Money. When I came up with that name, I thought it was cool. Like, that was like a big thing, money boss, be the boss, money. I don't know, money boss, be boss, but those were taken. So I decided to say, be the boss of your money. Little hokey, but what I really mean is I want you to be the boss of your money. It's very easy to lose control of your money. It's very easy to become overpowered by a lot of uh, financial stuff, financial junk, head trash. And we talk about too many subscription services, to understanding changes to the tax code. I'm not a CPA. You should consult with your CPA or tax advisor when it comes to tax information. Just want to get that in there. But that's something we talk about here. We talk an awful lot about investing, the stock market, because if you think about it, there's 2 points of financial planning and financial advice. Part of it is understanding a Roth IRA, a traditional IRA, knowing where to put your money and how much money to put away each month, and making prudent decisions, your credit score, mortgage rates. We talk about all of these things. By the way, these are dependent on your questions. So if you do have any questions about personal finance or something you want me to cover on the show, I would love to hear from you, because your questions, your ideas is the best part of doing this. So I'd love to hear from you. If you have any questions, hit me up in the comments. If you're watching in the live stream, thank you. If you're watching in the replay, welcome to you as well. I'm here for you. So questions, if you have any questions, I'll see them, whether if you're watching the live or the replay, and I will definitely get back to you. So, but today I do want to talk at length about the market. Let's just do a quick catch up, because it does seem like we are in a generally flattish period. Things seem like they're just drifting lower. And I don't know. Is it me, or is there like some kind of pending sense of doom, in spite of the fact that the major averages, the Dow, the S&P, and the Nasdaq, they're still right near their all-time highs. I keep saying this, that this rally we're in is like the most hated rally. Just nobody believes it. Nobody likes it. Everybody has something to knock about it. I will say a good thing about this rally is, in spite of seeing a couple of large cap tech stocks take hits, the market still held up pretty good. So it's nice to see some other stocks holding things up besides just FANG M. Okay. FANGM, that's what we talk about all the time. That's Facebook, Amazon, Apple, Nvidia, Google, and Microsoft. You might be thinking, what about Netflix? No, Netflix is no longer in my FANGM. I substituted it for Nvidia, which, by the way, just split 4-for-1. So when you see it trading like 197, it's not because it went down from like 800. It's because it did a split. By the way, GE did a reverse split. So if you're wondering, like, did GE go up to 100? No, it didn't. It had a reverse split. So you didn't make the money on it that you may have thought you did. Okay. I'm sure you got that, though. So I see a comment out here already in the comments. We just see who that is. Hey, Josh, love you, buddy. Thank you so much for joining me. Sorry we didn't have more time to spend and hang out at the last LIE meeting. You may have noticed I got there a little bit on the late side, and the meeting seemed to have broken up quickly. Thank you, buddy, for stopping by. I really appreciate that, Josh. And so let's take a look. Let's take a look at a couple of things. I'm going to put on another screen for you. I'm just getting it ready, and a couple of things I need to. All right, let me get this going here. Let's take a look at the major sectors, how they did. I know you can't see what I'm looking at yet. That's because I didn't share the screen yet, but I'll share it now. Pop myself up in the corner. Okay. So let's just take a look at the major sectors of the market. What I'm showing you right here is the sector ETFs. Each ETF that represents or tracks a specific sector of the market. There are 11 general industry classification standards. Okay. The ones that did well today were utilities, consumer discretionary, healthcare, real estate. Financials are up a penny. We could practically nothing. No major movement to the upside. The loser on the day was building materials, energy, and industrials. I kind of hate to see that, because when industrials, energy, and materials are in the low end of the performing sectors, it's an indication that investors are worried about the economy. They see maybe a slowdown, and it looks like we have seen peak earnings. All right. We've seen peak earnings, peak stimulus. Now that the infrastructure bill is pretty much a done deal. I know it's not over till it's over, but it looks like it's a done deal to me. What's next? The child tax credits are already going out. That should help back to school shopping, and that should help holiday shopping. So I expect those to do well, but I think we already know about that. These are not new things. I think we're past peak everything. We're past peak help from the Fed. It looks like, also from everything I'm hearing and reading, is that the Fed wants to start peeling back, or reducing its bond buying that it does every month. It buys $120 billion of treasuries and mortgage-backed securities to pump money into the economy, help the housing market, keep interest rates low. The Fed's getting to the end of that. So without the Fed as this massive buyer of bonds, does that mean interest rates have to start trickling higher? We haven't seen interest rates on like the 10-year treasury move up yet, but that's the telltale sign that that we're looking for. And then after that, the Fed will start to, or is expected to start, raising interest rates. By the way, when you invest in the S&P, Dow, or NASDAQ, you actually can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Okay, who's out there? We've got a little heart there. Asher, good to see you, buddy. Thank you very much. Guys, while you're watching this, give me one of these, maybe one of those. I don't know if you could do that with a reaction, but definitely one of these, or maybe a smiley face or a wow or something. And this way I could see your name and see who's watching. I always enjoy that. So let's take a look what else we need to see. Okay. We have more to look at. The next thing I want to look at is this news that just came out. This is breaking news. Okay. CDC says 7-day average of daily U.S. COVID cases surpassed peak seen last summer. Some professionals, like Dr. Scott Gottlieb, former head of the FDA, thinks that we're going to see peak COVID pretty soon. And if you believe in that scenario, you could, then that means the reflation trade comes back into vogue. Airlines, cruise lines, anything that has to do with people getting together. If we see a slowdown in the economy and people stop going out, then the economy slows, but not necessarily bad for the market, for the stock market, because people go back into the work from home, stay at home companies, the stocks of the companies that allow us to actually live and work without having to go to work. I, for one, am vaccinated. So is everybody in my family. I don't mind saying that. Okay. But I wear this again. When I go through like the common areas, I use the men's room in my floor of my office building. I'm not saying I go on the floor. I'm saying the bathroom on my floor. Okay. Don't be funny. All right. When I go through like the lobby of my building, when I go to the gym, I'm back to wearing the mask. I don't wear it. If I go to Dunkin' Donuts, pick up some coffee, I'll put the mask on when I walk in. It's no big deal. If I'm meeting people outside, I don't. I mean, I guess everybody has their own little rules, but I want to be careful. I don't want to bring this stuff home. And other than that, Andrew Janisic is in the house. Thank you, buddy. Good to see you. Thank you. Got the thumbs up. You see that, man? You made me very happy. You are a good friend. Thank you. I hope you rode your bike over the weekend. It's been pretty good weather. All right, so what else are we looking at? We are going to take a look at overall general markets. Okay, this is the stuff that I look at every day. If you want to follow along, look for yourself. But the Dow off 97. It was off on Friday. No big deal. NASDAQ was up a little bit. Helps for the retreat in the NASDAQ that we saw last Friday when Amazon tanked about 7.5%. That was a huge drop, by the way, for Amazon to be down 7.5%. That's like, it gives back a chunk of its recent gains, pretty much all of it. S&P down 8%, gold off a drop, oil got hit pretty hard, down over 3%, 10-year treasury yield, see, down to 1.17%. Now, I know a lot of people are saying, oh, I don't worry about the 10-year treasury yield. That doesn't indicate anything. I think it does. And I want to be direct with you. I think the 10-year treasury, when it drops, I think it means that things are slowing down. Definitely not retreating. I'm talking like corporations are still growing. Earnings overall are still growing. The economy is still growing. But it's going to grow at a slower pace. So if things are growing at a slower pace, yes, that's good. Growth is good. And we expected eventually that the economy would slow its growth because we had that sudden snapback rebound in the economy after, the COVID restrictions were lifted. And now, we're starting to get into a steadier, more expansionary mode as opposed to a rebound mode. Okay. The economy goes from economic recovery to economic expansion. Economic expansion is a little bit slower, but longer lasting and steadier growth. But if people were betting on more recovery type growth, then even decent growth is a disappointment if it's slower growth. I know it's backwards, but that's how investors work. And the VIX is almost up to 20. I'll tell you what, we see the VIX climb above 20 tomorrow. Let me show that's this one over here. Okay. We see the VIX, it's like 19.46. We see that close above 20 tomorrow. And I'd be very comfortable saying we're going to see a tough week. So here's two things that I want you to know about. Okay. This is the first thing. There might be a little bit of it's not a delay on my screen. It's just I didn't put up. You see this? This is from the Federal Reserve Bank of Kansas City website. Okay. There's 12 branches of the Federal Reserve. And they're having their 2021 Jackson Hole Economic Symposium, as they do every year, in Wyoming, January 26th to January 28th. This is significant. I don't know if you could see that on your screen. Let me pop that up. It's a little small. Let me make that bigger. Okay. And this is a big deal. It's a very big deal because this is when it's expected that the Federal Reserve will give clear guidance regarding their slowing of the bond buying program that they do every month, their quantitative easing. And it's a huge quantitative easing. And are we ready to live without Fed intervention? Are we ready to live without the Federal Reserve doing what it's doing to keep pumping money into the economy? With all this extra money in the economy, I just had lunch with a client today. We met late today, late afternoon, which is why I didn't get a chance to put up a thumbnail and an announcement today for this, but that's okay. I met with a client who's a dear friend as well. And, we're heavily into stocks, and as most baby boomers are, because there's no alternative. There is no alternative. Tina, there is no alternative. And this is what it means when you hear that the Fed has forced investors into stocks. People have money, and I'm not talking like a little, you're talking like your retirement money, all of your money. Where do you put it? It earns nothing in the bank. And people get nervous. Hey, I'm going to retire. I've got to make this money last. I have to stay ahead of inflation. And inflation is running pretty hot right now. So everyone goes into the stock market because it's the only game in town. There is no alternative. And as a result, I see boomer accounts all the time that are just have way more stock market exposure, 70, 80, 90% than I did 15 years ago, 10 years ago, even 5 years ago. So what I'm doing, and it's not necessarily because people put that much of their money into stocks. Maybe you put, 40% in bonds and 60% into stocks, but the stock market's gone up so much that maybe you could be 80 or 85% stocks. And so it's time to start, I think, tamping that down if you cannot handle a big correction. There's a lot of talk that we're getting a 20% plus drop over the near term. Could we predict that? Is that going to definitely happen? I don't think anybody, if anybody tells you that they're predicting a 20% return, that like they know, I don't believe it. Now, if somebody says, I think we could have one, I'm worried about a correction this summer. Okay, fine. Not everybody agrees with that. Some major analysts are saying, hold on to stocks, go all in, we're going higher. Others are saying there's a correction. I think you have to make a decision that's best for you. That's based on your own personal finance. If you could handle a 20% plus correction in the stock market, because you know what that's going to do to your investment accounts, and you're going to be okay with that, and you have the time frame to wait for the market to recover and presumably go even higher, then you have nothing to worry about. If you don't have the time frame or the wherewithal, and you are close to retirement and you can't afford a 20 or 30% hit to your wealth, you really need to scale back on your stock market exposure. Like, you really need to do it right away. Don't wait. Don't wait for the perfect time. Nobody's going to ring a bell when the market's at a high and say, now is the time to do it. You have to make these decisions based on your own personal finance. That's what I'm saying. I don't worry if an analyst says, a top analyst says, market's going to crash next month. The market's going to go up through the end of this year. We all have our reasons for believing these things. Whatever your research dictates to, and I have my own feelings of where things are going to go. But feelings has got nothing to do with it. It's about your personal finance. If I have a client who cannot afford a 20 or 30% hit to their overall investment accounts, but I feel really good that the stock market's going to go higher, well, I'm still going by the client's personal finance needs and scaling back, because my feelings of the stock market has nothing to do with it, because feelings are just feelings. They're not premonitions. They're not guarantees. You can't go by feelings for forecasts. Well, I think this, I think that. No, you go by personal finance. You control what you can control. not by feelings. The problem is investors are so used to the stock market recovering after every dip and hitting new highs and recovering quickly. Like even when the pandemic started in March of 2020 and the stock market swooned almost 40% in a couple of weeks, it came back so fast. People didn't even, a lot of investors didn't even have a chance to consider doing anything. So what happens is eventually people become complacent. They're used to the market going up. And even though they're too high up in their risk level in their portfolio, they're not in a rush to do anything because they don't think there's any reason to act now. There's no impetus, no spark to make a move now. What I'm telling you is do it when there's no impetus, when there's no spark to make a move. This is what it means to be proactive and not reactive. I hope that makes sense. We've got a few people out here. Got a couple of comments. I hope I didn't. Ooh, I thought I lost my audio for a second. Okay, so we've got Asher. That was our conversation the other day. I'm predicting worse than that in 2022. That was our conversation. I really enjoyed our conversation, by the way. I really enjoyed meeting you in person, Asher. Even though we were friends already on Instagram, I think that is so cool that we already met on social, then we meet in person. Usually it's like the other way around. You meet in person, then you become friends in social. That was really cool. You're a good guy. Filippo is in the house. Hey, buddy, good to see you, man. Filippo, I see you have the that logo there for your company, but I'd like to see a picture of you there, okay? Don't make us all, miss out on that handsome mug of yours, okay? I mean, I was actually thinking of, since you're not using your picture, I was thinking maybe I'll use your picture for my LinkedIn profile pic. Did that sound weird? I was just joking, really. I was just joking. Now, damn it. Now the whole thing's just awkward. The whole show is shot to hell. It's just awkward now. I don't mean, let me just go on. Don't get emotional about money. Old adage of grandfather and grandchild. Grandchild loses his quarter in the sewer. He cries to grandpa. Grandpa says, son, it's not that you lost a quarter that has you sad. It's that it was your only quarter. Damn, I like that. Thank you for sharing that, Filippo. I love like little anecdotes like that are passed on. That is awesome. I'm going to share one with you, okay? What's the one I want to share? Oh, this is for people who are in business development in some kind of sales position, okay? Which I think really could include all of us. So here's what my dad used to say. There are days when you make your money, and there are days when you earn your money, and they're not always going to be on the same day. Right? When you have to earn your money before you make it. We've got to do all the things right, the networking, the business building, all of those good things. Filippo says, you may use my photo for your LinkedIn. Honored. You got the hair, you got the mug, you got it going on. Nick is out there. By the way, Nick is going to be my guest. Nick, he is a certified financial professional in North Carolina. And Nick is going to be my guest. And I'm looking forward to that. We have to decide what day, Nick. Is it going to be tomorrow or is it going to be next Tuesday? I would love to say Thursday, but I have to be somewhere by 5, and I don't want to have to rush through it. I don't know if you know this, Nick, but I'm on the board of directors of the FPA Long Island chapter, and I am sponsoring an outside cocktail hour, happy hour on Thursday at 5. So I'm going to do that. You want to do it tomorrow? Tomorrow. Okay. Send me a picture of you. Any picture will do. It could be your usual profile picture. It could be just a cool picture of you hanging out. I'll make the thumbnail on Canva, and then I'll post it for tomorrow. And I already have the email you sent with your artwork. Nick is like the visual teacher of LinkedIn for personal finance. His content is amazing. And after we go have Nick as a guest, you're going to definitely want to follow him. And his stuff is awesome. And he's got a really good heart. All right. So that's what's going on. So this coming Friday. So today is the 2nd. Okay. So on Friday, the 6th, I'm doing fingers here, the 6th. Okay. We have the July non-farm payroll figures coming out. And then a few weeks after, we have the Jackson Hole uh, symposium, the Jackson Hole economic symposium put on by the Kansas City branch of the Federal Reserve. I think between now and that day is going to, between now and that symposium, is going to tell us everything we know that we need to know to make a determination of if the Fed is going to start tapering the end of this year, which most people don't expect, or early to mid next year. I think around early to mid next year is becoming a pretty reasonable expectation to when the Fed starts to taper its bond buying. Or maybe they'll go from 120 billion to 115 billion per month. It just, the sooner they could get to tapering their bond buying to zero, the sooner they could get to raising interest rates. So if they taper quicker, then we have to factor in interest rates, short-term interest rates being raised by the Fed quicker as well. This is going to be a lot of fireworks. I think this is going to create a lot of uncertainty and a lot of turmoil in the stock market. Just my humble opinion. Okay. Who's invited Thursday? I mean, you're welcome to join us. It's financial advisors, it's estate planning attorneys, it's people who are in the 401k business, third-party administrators, probably some accountants. We're going to be at Refuge at 5:00. If you would like to go, come as my guest. Let me know, and you're in. You've got you'll know a few of the people there. Mark will be there as well, my friend Mark Badami. All right, so that's about it, guys. Thank you very much for watching. I cannot believe we've been live now for 27 minutes. The time goes by so fast. I will be back tomorrow with Nick Nielsen from North Carolina, and we're going to have an awesome time tomorrow. And Josh says, cool. You're cool, man. Thank you very much. All right. See you tomorrow. Bye.